Hope you guys are doing well. And today we're going to look at some condors and we will go from there. So, if you can see my screen, this is just a portfolio of different condors that we put together. And we will look at the strategies one by one, starting with some longer dated ones and then go into shorter dated ones. None of these are 0-day strategies. We will do that another day, maybe even tomorrow. We'll start looking at some of that stuff. 0-day has its kind of own set of rules that sometimes get crazy. So today we're just looking at some different ones other than 0-day. So just real quick, just from a show of hands or from talking, you can put in the chat, how many of you do iron condors? Starting, did you start with iron condors? Have you traded iron condors? Does everybody know what an iron condor is? Matt has done. And everyone, for those of you who don't know, Matt is one of the founders of Option Omega. So as always, you'll see him in the Discord area, just owning things, being boss. Okay, you guys, looks like a lot of you have traded them. Okay, just in case you haven't, just the quick, easy version is it's the equivalent of selling a call spread, short call spread, and a short put spread together. So you can make them symmetrical, you can make them asymmetrical, you can do all sorts of things with them. So we're going to look at some today. And again, I don't trade many condors at this point in life, but this is the fun of looking through this stuff with Option Omega is I often ask myself, why are you not doing that? And sometimes the answer is self-evident, sometimes the answer is not. But let's take a look. So let's start out with a 16-day condor. And as always, if you have a trade that you want to look at, a condor that you want to kind of show or share, we can look at together and talk through it. Feel free. This is the time to do that. We want to make this a space to be able to think together how to make trades better. So this is a 16-day iron condor, and it's year to date. All of these tests today, just for to clean them up a little bit, have been year to date, and all of them are going to be using one contract max, so that we can kind of just look at the mechanics of the trade apart from sizing. So this trade is year to date, and we're going to sell a 25 delta put and buy a put 10 points out. And we're going to sell the 30 delta call and buy the 10 delta call 10 points out. All 16 days to expiration. Off the top of your head, why would I put a 25 delta put but a 30 delta call? What do you think some of the advantages of doing that would be in an iron condor? Any thoughts? And as always, don't be shy. Feel free to just talk or chat. You're amongst friends. Why would we do a 30 delta call but a 25 delta put? Any takers? Going once, going twice. Well, if you've ever sold any call spreads, you know that a lot of times the juice in them, oftentimes, I found, at least personally speaking, anecdotally speaking, that a lot of the times when you get tested on a trade, it's usually to the upside, particularly in a historic 10-year bull market. So looking at things this year, even this year, it has worked well to go higher up on the deltas with the call. You get a little bit closer to delta neutral. I don't know exactly what the deltas would be on this, but I'm pretty sure you'd probably get pretty close to delta neutral, maybe even positive. Delta just a little bit still. So it's just a way to kind of even it out from a delta perspective. That's all we're trying to do. So we are putting that on, and we open it at 10 a.m. every day, and we're allocating 100% of our portfolio, which doesn't matter because we're just using one contract at a time. And we have two exit criteria. We are going to take this off when it reaches a 20% profit target, or we're going to take it off when the shorts get tested. And then I have some opening and closing fees in here, and I require 2 hits at the profit target before we take it off. So that's the trade. As you can see, it does pretty well. I mean, it's a 57% win rate, and you're in the trade about 3.5 days. There's no stop loss per se, so you're only getting out when it's tested. But because you have a small width of 10 points between the shorts and the longs, you're not, at least with one contract sizing, you're not in danger of absolutely getting wrecked. That's a good opportunity to step in here and say options involve risks and are not suitable for all investors. This is backward looking, not forward looking, and this is not financial advice. So please consult with your financial advisor for any particulars. With that being said, over time this year, 57% win rate, and it does pretty well. So that's the first one. Any questions about that?